Coming up, the Australian share market closes at a record. We're on US interest rate watch and we take a look at the lasting COVID economic impacts for year on. Here's your daily 10-minute business and finance news wrap for this Friday, the 28th of March, 2024. The Australian share market rose 1% today. We'll speak with Elizabeth Tian from Citi for more. But first to March, which marks 4 years since the COVID lockdown started. But despite the disruption, global share markets have risen, some to record highs like the ASX today. AMP's chief economist Shane Oliver says there are 7 key lasting economic impacts, including bigger government and more public debt, tight labour markets and faster wages growth, reduced globalisation, inflation and higher interest rates, worsening housing affordability, the work from home trend and faster embrace of technology. So some good changes, some not so good, but not enough to deter investors. So for more, I spoke with Shane Oliver from AMP.
Well, I think the key ones are it has ushered in bigger government. The role of government in the economy has expanded both globally and in Australia. You just look at the projections for government spending in Australia. They're far stronger than they were pre-COVID. We're also seeing a decline in globalisation, a more fragmented world, which is something we hear a lot about and partly associated with geopolitical tensions, which were heightened by the pandemic. I think the pandemic, all the spending we saw, kicked off inflation. There's no doubt about that. The spending combined with the supply side disruptions set off an inflationary cycle, but it's probably also taken us out of that low inflation malaise that we saw prior to the pandemic. But I guess one of the big positive ones is that we've taken up technology faster. We've embraced technology to a much greater degree. So it's not all negative. But just one final negative I should put in there is that we are looking at more expensive housing than what we saw prior to the pandemic. So most of the impacts are somewhat negative, but it's not all negative. That faster embrace of technology, more working from home, you'd have to say a lot of that is positive.
Let's break some of that up. We've spoken a lot, obviously, over the past couple of years about rising inflation, interest rates and the impact on the housing market. As we approach the government federal budget, can we talk about the government's role in managing finances post-COVID? As you mentioned, the government's now bigger. Public debt has ballooned. Will Australia ever pay down this COVID debt hangover? And what are the implications?
Well, I tend to think that we probably won't. It'd be nice to think that we would. But to do that, we will have to run big surpluses for many years. And I think given the pressures on the federal government budget and state budgets, federally, we know all about the NDIS, increased defence spending, increased aged care spending, and so on. Those things are going to put immense pressure on, making it very hard to sustain surpluses in order to pay down debt. So I think the more likely scenario is that we'll have to learn to live with this high level of debt. The downside to that is that if another economic crisis comes along, at some point, the government may not have the same degree of flexibility to respond to that crisis. In other words, we haven't put money aside for a rainy day. So if a crisis comes along, we get that rainy day, we're not in as strong a position to respond to it. The other possible implication, and this is a global issue as well, is that one way to get debt down is to inflate your way out of it. And that's what we sort of did after World War II. That we had relatively strong growth at that point in time and some inflation, and that enabled the value of that debt relative to the economy to go down, even though it was never really paid down. Hopefully governments will avoid that option because inflating their way out means we see ongoing rises in the cost of living.
So as you mentioned, it's not necessarily all negative. A lot of those new trends, working from home, for example, do you see those being sustained long term?
Well, to be honest with you, I think they will. If you think about a couple of big things that happened in the pandemic, those who use computers found themselves working at home more. And once you see the benefits of working from home, both in terms of cost reduction for businesses, they don't have to pay as much rent, and the flexibility it implies for workers, it's hard to undo that. We're not going to go back to a pre-COVID world where we came to the office 5 days a week. I think we'll end up with some sort of happy medium in between. The other one is the take-up of technology. Obviously, right now we're using technology to do this interview. A lot of people do meetings via Zoom or Teams or something. Remote meetings are quite common. It means less business travel around the world, which means less pollution. So I think a lot of those trends will be sustained, not at the same level they were through the pandemic. And the reality is, as newer companies enter the fray, and as time goes by, you do see new companies come along, they're more inclined to embrace that new technology and working from home. So the odds are that the work from home phenomenon will not only be here to stay, but it could intensify as the years go by.
Shane, finally, you say that on balance, the lasting impacts make for a more fragmented and inflation-prone world for investment returns. We know that investments can be quite volatile as a result. But at the same time, many global markets, including the ASX, has hit records. What gives here?
Well, that's why you'd have to say it's not all negative. Who would have believed that the Aussie economy would be this strong 4 years after what happened in those lockdowns? At the time of the lockdowns, many thought the sky was falling. And here we are with pretty strong labour market still, the economy still growing despite all those interest rate hikes, and of course the share market at or around record levels, and that's pretty much the story right around the world. I think you've got to bear in mind that share markets will fluctuate. As we all know, they are very volatile. We did have a rough ride in 2020. We had another slump in 2022, so we have seen that increase in volatility. But by the same token, right here, right now, share markets are thinking, well, we've come through all of this. The economies haven't collapsed. We haven't gone into recession. And in the meantime, we're looking forward to lower interest rates sometime in the next 6 months. And so I think that largely explains why share markets are at record highs. And the cream on the top, particularly in the US, is all this enthusiasm about artificial intelligence, which of course has boosted tech companies. So you can sort of understand why markets are at record levels, even though we have come into a more fragmented, perhaps more volatile and constrained world compared to what we had pre-pandemic.
That is AMP Chief Economist Shane Oliver.
Now, Market Day on the SBS On the Money podcast.
So the Australian share market had a good day to end the shortened working week and the end of the March quarter. The S&P ASX 200 up 1% to 7,896. That's a record. For more, I spoke with Elizabeth Tian, analyst at Citi. Liz, Australian shares hit a record high again today. Why?
Yes, it's really the leads, Ricardo, from offshore as well. US markets obviously very strong and they're hitting record highs. Locally in our market, it's a lot of green. We're seeing mining stocks higher, lithium stocks, gold stocks higher, and also even across some of the more rate sensitive type stocks like the banking sector. And that's really on the expectations that central banks are going to lend support to equity markets, including the Reserve Bank. We expect the Reserve Bank to have its first rate cut in November. So that's been looked at quite favourably.
It's the end of a shorter working week. It's the end of the quarter, the March quarter. The ASX is up about 4% so far this year, or in those 3 months. The ASX is also up around 8% from October to December. So it's been a pretty strong rally for the markets, is what I'm trying to say. How would you describe the past few months?
Yeah, no, last time we spoke, I think was late last year, Ricardo, and I think what's been very surprising is how resilient equity markets have been. If we look at the US market, we look at the Australian market really sitting at near all-time record highs, and that's on the back of the fact that, there is expectations that all the central banks really are now looking at a rate cutting cycle, except for probably the Bank of Japan. Earnings are still good, and despite all these rate hikes, nothing's kind of fallen out of the system. There've been no, big crisis of any sort. So that's really seen markets continue its trajectory. Obviously, a lot of that focus is on the technology stocks from offshore, the big Magnificent Seven, but that's the whole risk on investors comfortable with, central banks looking to eventually cut rates has been very strong for markets.
Okay, in the US, inflation data is due, so a big key economic indicator there. What's it likely to mean for interest rates in the US? Because we know it's going to fall, but isn't the big question when?
Yeah, absolutely. Look, it's the last two numbers weren't falling quite as much as what the market was anticipated. But as you say, Ricardo, it is expected to fall. But we've got to remember the latest narrative coming out of the Reserve Bank was, the Federal Reserve, was that even if interest rates and their CPI data doesn't fall right back down to that 2% target, it really seems to the market that the Federal Reserve, Jay Powell, is happy for it to kind of float around the 2+% mark for a time and let then interest rates eventually start cutting. So it's not, we've got to get to 2%, we've got to keep, inflation's number one, they're kind of balancing that with the economy, with jobs, really trying to have a strong landing or no landing and not really trigger recession, because the economy is obviously quite robust in the US.
That is Elizabeth Tian there from Citi.
This SBS On the Money stream is provided for informational purposes only. The content in this stream should not be understood as constituting advice or a recommendation. It is not personal advice and it does not consider your personal circumstances or objectives. You should contact a licensed professional before making any financial decision.